Welcome once again to our commerce classroom. Consolidated Financial Statements, Ind AS 110. In this session, we discuss about adjustment of preference shares issued by subsidiary. Preference shares issued by subsidiary. When the subsidiary company has issued preference shares in addition to equity shares, the accounting treatment is as follows. Firstly, preference dividend should be deducted from the profits of the subsidiary company, irrespective of whether they have been declared by the company or not. Parent company's share in preference dividend is included in its profits and is shown in the consolidated balance sheet. Secondly, non-controlling interest includes the preference shares held by outsiders plus dividend accrued on them. Thirdly, the format of computation of goodwill or gain from bargain purchase. In case of computation of goodwill or gain from bargain purchase, from purchase consideration, we have to deduct paid up value of shares acquired by holding company in the subsidiary company and share in pre-acquisition profit. So our format, purchase consideration for equity shares plus preference shares, amount shown in outer column. From that purchase consideration, we deduct paid up value of shares acquired by holding company in subsidiary company, equity share capital and preference share capital. Then share in pre-acquisition profit. The total of these three, paid up value of equity share capital, paid up value of preference share capital and share in pre-acquisition profit, we deduct these three amounts, the total of these three amounts from purchase consideration. Then we get goodwill or gain from bargain purchase. Then we solve one problem. On 1st April 2019, X Limited acquired 80% equity shares and 30% preference shares of Y Limited for rupees 1,95,000 and rupees 30,500 respectively, on which date the general reserve and surplus of Y Limited showed the balances of rupees 30,000 and 4,000 respectively. The statements of financial position on 31st March 2020 stood as follows. On right side, we have columns for X Limited and Y Limited, equity and liabilities, shareholders funds, share capital, equity share capital, rupees 10 each, X Limited 12 lakh, Y Limited 2 lakh, 10% preference shares are rupees 10 each. For X Limited, no preference shares, Y Limited 1 lakh, reserve and surplus, general reserve, X Limited 4 lakh, Y Limited 40,000, surplus, X Limited 1 lakh, Y Limited 39,000. Then current liabilities, trade payables, X Limited 2,30,000, Y Limited 1,71,000. Then total of equity and liabilities, X Limited 19,30,000, Y Limited 5,50,000. Then assets, sundry assets, X Limited 17,04,500, Y Limited 5,50,000. Non-current investment, for X Limited only 80% equity shares in Y Limited at cost X Limited 1,95,000, 30% preference shares in Y Limited at cost for X Limited 30,500. The total assets X Limited 19,30,000, Y Limited 5,50,000. Then our solution, working note. Firstly, we compute post acquisition profit or revenue profit of Y Limited. From our question, surplus on 31st March 2020 39,000. From that surplus, we deduct surplus on 1st April 2019, given in our question 4,000. 39,000 minus 4,000, that comes to 35,000. In this year, we transferred 10,000 to general reserve. We add these amounts, add transfer to general reserve 40,000 minus 30,000, that comes to 10,000. Then current year's profit 35,000 plus 10,000, 45,000. From that 45,000, we have to deduct preference dividend. Preference dividend 10%. 1 lakh into 10%, that comes to 10,000. Current year's profit 45,000, preference dividend 10,000, 45,000 minus 10,000, that comes to 35,000. Our revenue profit 35,000. Then computation of pre-acquisition profit or capital profit of Y Limited. General reserve on 1/4/2019 30,000, given in our question. Then surplus on 1/4/2019 4,000. Then total 34,000. Our capital profit 34,000. Then we compute non-controlling interest. Non-controlling interest, interest held by outsiders in the subsidiary company. Paid up value of 20% equity shares. We know 80% equity shares are held by holding company and 20% equity shares are held by outsiders. So paid up value of 20% equity shares, 2 lakh into 20%, that comes to 40,000. Then 70% preference shares are held by outsiders in the subsidiary company. Paid up value of 70% preference shares, 1 lakh into 70%, that comes to 70,000. 70% preference shares are held by outsiders. So 70% of preference dividends available to outsiders. 10,000 into 70%, amount comes to 7,000. Then capital profit and revenue profit included in NCI on the basis of equity shares held by outsiders. 20% equity shares are held by outsiders. So 20% of revenue profit, 35,000 into 20%, 7,000. 20% of capital profit, 34,000 into 20%, 6,800. The total of all these 40,000 plus 70,000 plus 7,000 plus 7,000 plus 6,800, that comes to 1,30,800. That is what our non-controlling interest held by outsiders in the subsidiary. Then we compute goodwill or gain from bargain purchase. For computation of goodwill or bargain purchase, we deduct from our purchase consideration paid up value of shares held by holding company in the subsidiary company and share in the capital profit of subsidiary company. Here, purchase consideration, amount paid for acquiring equity shares and preference shares in Y Limited, 1,95,000 plus 30,500. Purchase consideration, 2,25,500. From this purchase consideration, we deduct paid up value of 80% equity shares, 1,60,000. Paid up value of 30% preference shares, 30,000. 80% of capital profit, 27,200. Then total of these three, 1,60,000 plus 30,000 plus 27,200, that comes to 2,17,200. 2,25,500 minus 2,17,200, that comes to 8,300. Goodwill 8,300. Then before preparation of consolidated balance sheet, we compute reserve and surplus. We have to show in consolidated balance sheet. General reserve X Limited given in our question 4 lakh. Surplus of X Limited given in question 1 lakh. Share in revenue profit of Y Limited, revenue profit 35,000. 35,000 into share 80%, that comes to 28,000. Then 30% of preference dividend in Y Limited, 3,000. The total of all these 4 lakh plus 1 lakh plus 28,000 plus 3,000, that comes to 5,31,000. That is what the reserve and surplus we show in our consolidated balance sheet. Then consolidated financial statement of X Limited and its subsidiary Y Limited on 31st March 2020. At the time of preparation of consolidated balance sheet, we have to remember one thing. From the liability side of balance sheet of subsidiary company, we eliminate share capital and reserve and surplus. From the asset side of holding company, we eliminate non-current investments. Here non-current investments means investment in the shares of subsidiary company by the holding company. Equity and liabilities, shareholders fund, share capital, equity share capital rupees 10 each, 12 lakh. Reserve and surplus 5,31,000, we already computed it. Then non-controlling interest 1,30,800. Current liabilities, trade payable, we add trade payable of X Limited and Y Limited, 2,30,000 plus 1,71,000, that comes to 4,00,000. Total of equity and liabilities 22,62,800. Then assets, sundry assets, we add the sundry assets of X Limited and Y Limited, 17,04,500 plus 5,50,000, that comes to 22,54,500. Then intangible asset goodwill, we've already computed 8,300. Then total assets 22,62,800. I think the adjustment of preference shares and preference dividends explained here is clear for all of you. We will meet again in our coming sessions. Till then, goodbye.